I'm Alex, welcome to the channel and thanks for tuning in. So in today's video, we're going to be talking about Switchback Energy and the SPAC deal they have with Chargepoint. Now if you haven't seen the video I made on this company previously, then I definitely recommend checking that out, where I go into a lot of detail on some of the key issues. However, this video is going to be more of an update video, and this is going to cover some of the key reasons about why we should be really excited about this company. As part of this video too, I have done some analysis on why the opportunity is perhaps even greater than they've laid out in their investor presentation, so you definitely want to stick around for that. And as always with videos on this channel, we're going to touch on the key risks which the company faces, and the mitigants that I see against those and why I'm not particularly concerned by them. If you're new to this channel and you like investing related content, then hit the subscribe button. This channel is all about frank, honest and unbiased discussions about stocks. We'll always address the risk and we'll never hide anything, no matter how ugly it may be, which ultimately means sometimes we get a lot of dislikes on this channel. So, smash that like button, help improve the like to dislike ratio. As always, I'm not a financial advisor, this video is purely for educational and entertainment purposes only, but let's get straight into it. Firstly, an investment into the infrastructure and electric charging is almost like an index for the electric vehicle sector. You can almost never lose. Now hear me out. If you believe the future of the automotive sector is electrification, then investing in the infrastructure which supports that is the smartest investment decision. If to capitalise on this trend, you're making an investment into a specific manufacturer, you are taking with that investment some adoption risk. The sector is still very young, still very nascent, and there's a chance that you don't pick the winning horse in this race. By investing in the infrastructure, you mitigate that risk somewhat. Now, to put this into context, why don't we compare it to another industry that's gone through a massive transformation in a similar way? That sector being the mobile communications or cell phone sector. Now, 15 years ago, someone may have invested in one of the market leaders in the market then, Nokia, Motorola, Sony Ericsson, for example, thinking that they had the position as market leader and they'll continue to be market leader going forward as the market grew. Those businesses are product businesses. For them to be winners, consumers need to select and choose their products. As the market evolved, consumer preferences changed, new competitors came into the market, and those players lost a massive amount of market share. A smarter investment here would have been an investment into one of the infrastructure providers, those providing the connections for the cellular devices or mobile phones. For those companies, there's less of a product risk. As the number of devices sold each year increases and the number of devices being used each year increases, demand for their product increases. Consumers need a connection to use their mobile phone, it's mission critical, and so those players grow with the market and don't have the same product risk that the manufacturers have. With the benefit of hindsight, we can obviously see that as smartphones penetrated the market more, players like Nokia, Sony Ericsson, Motorola all lost a massive amount of market share to players like Apple. The very same thing could happen to the electric vehicle market, and that's why an investment into the infrastructure perhaps is the smartest investment to make. Secondly, Chargepoint is the largest player in the US market. It has a 73% market share, and with this comes a massive amount of potential. Every metric forecast for the electric vehicle sector is forecasting growth. Number of vehicles on the road, number of EVs sold each year, number of charging stations required. Nobody seems to be disputing this, which is great for Chargepoint. Politically, this is getting a lot of focus too. In the first US presidential debate between Trump and Biden, the topic of charging infrastructure was discussed, with the number of potentially 50,000 charging stations being built over the next 10 years. If that was to materialise, this would mean massive incremental growth for Chargepoint, way above what they've outlined in their investor presentation. Now on screen now is a little bit of analysis which I've done, and I won't bore you with the details. If you are interested to see more detail about what I've done and how I've conducted this analysis, then let me know in the comment section below, and if there's enough interest I can put together a video on that. But basically, what this is assuming is that if Chargepoint win the number of new chargers proportionate to their current market share, assuming those are built evenly across the 10-year period, this would imply an additional nearly $1 billion in incremental to Chargepoint over the next 6 years, above what they've outlined in their investor presentation. And look, this news is really exciting for anyone invested in the charging infrastructure space. Chargepoint won't be the only winners from this. Other names, Blink, etc., are all set to benefit from this as well. Thirdly, we should think about the resilience that Chargepoint has and its unique business model that underpins that. The high levels of recurring revenue which a business generates are more akin to that of a software company, so perhaps one could argue it does command a premium valuation to other competitors in the sector. Now, as with many of the other players in the charging infrastructure sector, there is a degree of product risk. Ultimately, the businesses are selling a product to enable you to charge your electric vehicle. However, with Chargepoint, you have a subscription model which underpins that. Its customers enter into contract with them and pay them annually for ongoing services. Now this is particularly interesting, especially given where we are in the economic cycle, when consumer disposable incomes are decreasing. Now what typically happens is that when disposable incomes fall, people are less likely to make the capital outlay to purchase a charging infrastructure. However, once you've installed that infrastructure, it's mission critical to you, so you do have to continue paying Chargepoint if you want to continue refueling your vehicle. The interesting flip side we may see to this, however, is grants and subsidies given to consumers in order to stimulate the economy again, to encourage them to buy new vehicles or buy new charging infrastructure. And ultimately that could help offset some of this. And ultimately that could help offset some of the decrease in actual product sales that we may see in these charging infrastructure players. That being said, versus its peers, Chargepoint has the most resilient business model. Now, I mentioned earlier this perhaps justifies a premium valuation to its peers. Now, for the avoidance of doubt, I'm not talking about difference in market cap or enterprise valuation. I'm talking about relative metrics. For example, enterprise value to sales, price earnings multiples. Actual overall valuations make no difference when you're comparing two businesses like Blink and Chargepoint, for example, which are both different sizes. More relevant comparable metrics would be metrics such as enterprise value to sales, perhaps enterprise value to number of charging points in place, enterprise value to number of active users. These are all metrics we can use to benchmark the valuation of Chargepoint versus its peers. And because of that more resilient model, because of the high levels of recurring income versus its competitors, perhaps those multiples can be at a premium to the peers. Typical multiples such as price earnings multiples, EV to EBITDA, they're not relevant when the company is at this stage of its growth and is not yet profitable. Now, the fourth thing we should be excited about is where we are in the news flow cycle and the potential catalyst for price increases that we may see over the coming weeks. Now, the trend we have seen this year is a greater focus and a greater scrutiny on SPACs, particularly those in the EV space. What this ultimately means is that news flow, whether positive or negative, has a disproportionately large impact on the share price versus what we may see from companies in other sectors. However, this also presents itself with an opportunity. One piece of news which we are expecting from Switchback Energy soon is the announcement of its merger vote date. If this follows the same trend that we've seen with other EV SPACs this year, one could expect to see an increase in the price once that date has been announced. On the flip side of that, any positive or negative news, whether true or perhaps false, as we've seen with the Diamond Peak SPAC this year, can have a negative impact on the share price as well. Next up, we need to address the risks, as we do with all videos on this channel. Every good investor knows what the risks are of the investment they're making and has a clear view of what the mitigants against those risks are and why they're comfortable making that investment. And this is the part of the video where we address those. The first risk I see in the short term is the risk of bad news. Whether this news comes from reputable sources, disreputable sources, or as a result of timeline slipping that were previously outlined, this will have an impact on the price. However, personally, as a long-term investor in this company, I'm not too worried about this. If you are investing in this company purely to trade around the catalysts, then that certainly should be something you'd be a bit more concerned about, but personally, it's not something that's bothering me. Next up is the execution risk. What I mean by this is the risk that the company doesn't deliver on their strategy, doesn't retain their market leadership, and ultimately, using the example we touched on before, becomes the next Nokia of the sector. The impact here is a massive decrease in its valuation, and so as investors, it's something we should definitely keep an eye on. Personally, it's not something that at the moment I'm concerned about. Historically, they've delivered on their strategy and done so well. Going forward, it's something we should definitely keep a close eye on and keep monitoring the other competitors in the sector. If one competitor in the sector has a clear competitive advantage, then as investors, we need to carefully consider that and make a decision on what to do. The next risk I see is the pipe lockup or potential lack thereof. Currently at this point in time, it's unclear, but it's something that's being discussed a lot. This is particularly important in SPACs because we have seen a number of SPACs decrease in share price quite significantly upon merger with pipe investors exiting their large positions. Now, to take a step back, a lockup is a period of time for which certain investors, whether they be pipe investors, management, sponsors, are not permitted to sell their shares for. The reason these exist is so that people have a long-term interest in the company and aren't just going to exit as soon as the deal happens purely for a financial interest. What we currently know at this point in time, however, is it's slightly unclear with SBE. Before those pipe shareholders are allowed to exit their investment, they do have to be registered with the SEC, which does take a period of time. So we can be fairly confident that they're not going to be able to sell their shares on the day of the merger. However, I caveat that this is something that I do need to do more digging on. A lot of these investors in the pipe are not known for being event-driven investors, i.e. they're not just trading around the catalysts, and are more likely to be taking a long-term view on the company as well. As a long-term investor in this company, again, this is not something that significantly worries me. If we do see a dip in the share price post-merger, that's not something that unduly worries me. My time horizon on this investment is much longer than that. And ultimately, that short-term movement in price doesn't affect the compelling opportunity I see here. Personally, those are the key risks I see in the near term. In my previous video, I covered a lot more of the risks, so if you're interested, you should definitely check those out. But thank you so much for watching. I hope you found it interesting. If you like investing-related content, then subscribe to the channel. If you like the video, please smash the like button. And as always, let me know your thoughts in the comment section below. I find it so interesting to hear your thoughts and perspectives. But thanks again for watching, and I'll see you in another video.